lens. Really, really interesting. So what's going on? With big data, see what's happened is that before even it wasn't like there was no economic activity. It was. We were going to shops. We were moving around. It's just that now whatever we buy is being recorded. Whatever movement we are doing is being recorded. So, first of all, there is a lot of unstructured data such as images, videos, audio, right? Natural text. And all of this is like social media discussions, OMG, etc. This is not proper English. It's natural text. Structured is like stock prices, anything that you can put in a table. So now we've got all this unstructured data being generated, recorded, analyzed, and then that leads to so many insights that the machines can use, such as, for example, the sentiment of this natural text that from coming in from social media. Let's say you just take out data, hashtag Microsoft or hashtag MSFT, and then you try and analyze, are people positively talking about it or negatively talking about it? And then what's the relationship, what's the correlation of that sentiment score with the stock price? Is a higher sentiment score leading to a higher increasing stock price, right? So this is getting more and more involved within the active management. So if you're doing active management, it's getting tougher and tougher because it's becoming harder and harder to generate more returns than just a buy and hold strategy. And the reason for that is that the market is becoming really efficient. So what is an efficient market? If you remember from your discussion in equity, from market efficiency, that an efficient market is informationally and operationally efficient. So which means when we talk about information, everybody needs to have all the information. And they need to be rationally able to take decisions based on that. So with technology, information is becoming available to almost everyone, right? We're talking about public information through search engines and websites. And operationally also, markets are becoming efficient because transaction costs are going down. So as market efficiency is going up, what you are seeing is a much more increase in the amount of passive investing versus active, because people are saying, hey, why should I pay that high fees for active investment when the active manager cannot even beat the market? I'd rather just buy and hold using a low cost instrument. And we'll talk about what those instruments are, such as mutual funds, right, or exchange traded funds, which is even better, and we'll shortly talk about that. But what about the active funds? What about the active funds? They need to really leverage technology. And a very interesting space that we see is the mass affluent. Now, what that means is, usually an asset manager would talk to clients who had at least $1 million. Right, below $1 million, it doesn't make sense for the asset manager to give them their time because, of course, they could in the past only serve a limited number of customers because their time is limited, right? So they would then obviously try to focus on high net worth or ultra high net worth individuals or big funds. But now, because of technology, we can automate the process of asset management, right? And again, that's linked to this huge amount of data, which then becomes food for the machine to learn. And then once the machine learns, then you can give tasks to the machine, which the human would have to do otherwise. So that's how this whole artificial intelligence is working, that the food is the big data, because the machine cannot learn without data. So that data being recorded, reported, analyzed becomes food for the machine to learn, and then the machine learns, and then you can then delegate tasks to the machine which you would have had to do otherwise yourself. So that's where the artificial intelligence comes in, that intelligence which was yours initially, now you've just kind of put it into the machine and you can ask them to trade on your behalf. Now, what that enables us is to deal with customers who have greater than $100,000, right? Previously, we wouldn't really be interested in those type of customers because, physically your time was limited. But now what you could do is, because you could use technology and AI to serve them, You could just take a part of your brain, put it in the machine, right? Especially if it's supervised machine learning. Machine learning can be unsupervised as well, but that's discussed in a separate learning module. But if either way, whether the machine is learning through a supervised approach or an unsupervised approach, the point is you can delegate some work to the machine, and which enables you to be able to serve a segment of the market which we call mass affluent that hasn't been served historically, right? And you can serve them with lower fees, and you can even then come into business as a new entrant where previously maybe you've not been able to come into this high net worth or ultra high net worth business because there's a lot of competition by other funds. So I mean, if you want to set up your own asset management company, maybe this is a new interesting space for you. But then of course you need to be able to leverage technology. Right, so what do we see traditionally is that you've got these big funds, right, who serve the retail segment. Now, of course, not everybody has $1 million. Not everybody even has $100,000. A lot of people have what, $50, $60, $70 that they want to save to start with, right? Maybe $100 to start with, and that's how they start. And then they just put aside maybe a few hundred every month, or maybe a few hundred even every year. So retail investors are very small ticket sizes. So what is the mode for us to serve them? Well, we have pooled investment vehicles, right? Such as a mutual fund, which would then just get an expert, the fund manager, and they would do it for 100 different people, or maybe 1,000 different people, or maybe even hundreds of thousands, right? And this then becomes really cost efficient because, I mean, let me show you. So we're talking about mutual funds over here, which is a very, very small ticket size. And the same goes for exchange traded fund, which is my particular favorite, right? Because it has advantages that the mutual fund doesn't have. And I'll tell you about that shortly as well. That why ETFs are better than your mutual funds. And then we will move on to separately managed accounts, which is 100,000 and more. And then, of course, to more sophisticated options such as hedge funds and private equities, which is $1 million plus. But I want to talk about mutual funds in more detail before. So now look at these guys, right? I mean, John has what, 4,000, Jill has 6,000, Joe has 10, 50, 30. Some of them are individual, some of them are institutional. And what the investment manager is doing, that they're taking this total 100,000 and buying these 10,000 shares, right? So at least now the investment manager is not having to deal with this 4,000 or 6,000, which is very, very small, right? I mean, at the very least, they're dealing with a $100,000 portfolio, which is somewhat decent, right? So this way, these guys, Joe, Jill, and John, they get access to a professional fund manager, and the professional fund manager doesn't really have to bother managing such small accounts. He or she is looking at 100,000 minimum. So it's a very good structure, right? It's a very good structure, but ETF is better, right? And I'll just shortly tell you why ETF is better once we are done talking about the mutual fund in detail. So what are the advantages of mutual? And by the way, mutual funds came about first, and then they weren't able to do something, which is why then ETFs were invented. But mutual funds obviously came to the scene first, and they were really good. They are still really good because low ticket size to get started. Immediately you can get access to a diversified portfolio, because I mean, if you only have $100 to invest, you probably can't even buy one share with it properly, right? But if you put that in a fund, immediately it gets diversified across so many different shares. So it's a easy, low investment access to a diversified portfolio. You can take your money out whenever you want, because the fund manager obviously is not going to feel that much of a hit if you take your money out, right? It's not like everybody is taking their money out. So it's manageable for them, with some people coming in, some people going out all the time. And the fund manager can just do a high level performance and standardized reporting for everybody, right? They don't have to give individual service. Now coming to why we needed the ETF. So what's the problem with mutual funds? Now, the mutual fund, of course, one very important term to understand is the net asset value, And that is something we'll just discuss. That is, it's just whatever is the value of the investment divided by how many units you've issued to all the shareholders, and then what's the value of each unit in terms of the net asset value. And why the word net? Because obviously there might be some expenses or liabilities that we need to adjust, and we'll talk about that more shortly. But what I really want to emphasize on with you is open-ended and closed-ended and what that has to do with ETF. So please pay attention. See, the open-ended mutual fund can accept new investment, right? New investment is possible. It's not closed, it's open, so new investment is possible. In a closed-ended, new investment is not possible, because the way that works is that the fund manager will say, okay guys, I'm putting together a fund, who wants in? Everybody comes together. Let's say the fund is for 100 million, and that's it. Fund is closed. No new investment can come in. But the good thing with a closed-ended fund is that trading is possible during the day, which means you got a number of units, and you don't have to wait for the end of day to then go to the fund manager and say, hey, I want to cash in my units, or I want to buy new units. That's not possible. There's no new units being issued, and there is no cashing in of old units either. The way you sell your investment in a closed-ended fund is that you sell your units to somebody else, right? And that is done during the day. So the good thing is that markets go up and down during the day, right? Let's say from 9 a.m. to 4 p.m. there's going to be up and down, and you can buy here, sell here. And you can do that for an individual stock as well. I mean, if you just want to trade, you can say, oh, I'll just trade an Apple stock or a Google stock. Well, I don't want to buy just one stock. I want a diversified portfolio. But at the same time, I want to be able to buy and sell during the day. And that is possible with your closed-ended fund. But the problem with closed-ended fund is that it is not going to be able to take new investment. So that's a problem, right? What if I want to invest in this and the sellers are just not available? So then how am I going to add my money? So the open-ended fund, yes, the new investment is possible, but only end of day trading, which means if you want to add money or take your money out, you have to deal with the fund manager, right? It doesn't trade during the day. Now that's where the ETF comes in. ETF is a structure where you can actually do both. You can increase the amount of investment, you can reduce the amount of investment, and it is done in real time. So new units are being sort of created during the day in real time if the demand is high, and units are actually being cancelled in real time if the demand is falling, right? So if the demand for this particular fund goes up, new units are issued in real time during the day, and vice versa. So it helps you trade during the day, and you can scale and reduce down scale the investment up or down as possible. So that's where ETF comes in. We're going to talk a lot more in detail about both open and closed-ended and ETFs. So let's go through it in a methodological manner, where we're going to talk about net asset value, open-ended, closed-ended, and ETF. So net asset value is very straightforward. You've got the value of all the assets in the fund. There might be some liabilities that the fund has, and why would they need to have those liabilities? Well, because what if there is some redemptions, people want to take some money out, but the fund manager doesn't want to sell the stocks because maybe they are not at good prices, right? Or maybe there's just no buyers available in the market. Think of COVID lockdown announcement. The market crashed, right? And people want to take their money out. So how is the fund manager going to give them their money? Maybe they'll take a loan, right? And obviously that is then a liability. So the fund value will go down, because the net asset value will then be calculated by taking the value of the assets minus the value of the liabilities. And then depending on how many units are there of the unit holders, and not the number of total shares, right? I mean, don't confuse these shares with what are the shares inside the assets. So that are going to be like Apple, Google, Microsoft, Amazon shares, right? But these shares are the units of the fund itself. So if there is $100,000 worth of assets divided by 10,000 units, of the fund, right? So the net asset value per unit or per share would then be $10. Now, open-ended fund, new investment is possible. So new shares can be issued, right? And funds can be withdrawn, but this is done at end of day, right? So at the net asset value. So at the end of the day, not during the day, at the end of the day. So they can be bought or sold only once at the end of the day and at NAV. So at the end of the day, what will happen is the fund manager will calculate the net asset value and they will say, okay, you want to buy new shares, we can do that for you. You want to redeem some of your shares, we can do that for you as well. It will be done very close to the NAV, right? And it will be done end of day, and you have to deal with the fund manager. There is no other way to increase or decrease your investment in this. Now, closed-ended fund, this is a completely different story. You can trade during the day, right? But you cannot put new money in. Whatever money you have, you can buy and sell those units to other investors, with other investors in the secondary market. It's just like trading a stock, right? You can even short it. You can short sell it, you can buy or sell it on margin. So it just trades like regular shares. And what ends up happening because of that it doesn't really trade at its NAV. Sometimes it trades at a premium or a discount. Mostly what we have seen is that it does trade at a discount to the net asset value. And this is something we talked about in your market efficiency reading in equity, that your closed-ended fund usually trades at a discount to NAV. Now, what is front-end load? Now, see, when there's marketing staff, sales staff that works for these mutual funds, right? And the way the mutual fund pays them is that they give them salaries, but they also give them a commission. And the way that commission is charged to the client and then paid to this sales staff is something called through the front end load, which is for the entry. There might be a back end load as well if you want to take your money out. So they might deduct something just to discourage the redemption. But at the time of investment, a certain percentage can be charged, and this is called front end load or entry load or back end load, which is the exit load. Majority of the times what I have seen is that you can get that waived, right? Depending on your relationship with the company, and if you can try and get that waived. So some funds just don't have it altogether, and even the ones that do have it, there is a possibility of getting it waived, right? Because obviously they charge a fees, right? So, I mean, if you think about it, when they make a return for you, they might charge a performance fees, but even if they don't make a return for you, they charge a management fees, which is, let's say 2% of assets under management. So whatever you're investing in terms of the dollar amount, the assets that they are having to manage for you. So the assets under management, they'll charge like 2% or 1% of that annually, fixed, right? And then there might be a performance fees as well, which is usually there in hedge funds and private equity, not there in mutual funds, but can be there, right? So, I mean, so they're going to charge you a front end load when you're doing the investment, then they're going to charge you the management fees, and then they might even charge you a performance fees. So it doesn't really hurt to ask them to waive the front end load, right? Anyway, so what do these guys invest in for you? They could be putting your money in the money market, which is like government short-term investments like T-bills, treasury bills. You could be doing corporate commercial paper, right? So that's pretty interesting. You could be doing corporate and government bonds, right? So longer term maturity, more than 1 year. You could be even getting into preference shares. So that's pretty interesting too. And then of course you can start adding equity to it, which could be domestic or international. And then you could have a balanced fund, which then does both stocks and bonds. And of course, we are seeing this huge demand for just passively managed funds, and that again ties in with the market becoming more and more efficient, and it's just being more fruitful to just buy and hold because it's lower fees, better return. Why would you want to pay somebody higher fees, right? Especially if they're not really being able to outperform the market. A very interesting option is separately managed accounts, and here it's direct investing. So, I mean, so far what we've been talking about is indirect investing, that the individual gives their money to the fund and then the fund invests it in the market for them. This is indirect. You could do direct as well, where the individual opens and their account with a brokerage firm instead of a mutual fund and directly starts buying and selling assets, and then you can have an advisor instead of a fund manager. You can have an advisor helping them to manage this separately managed account. Now, there's obviously costs involved here. So what we would want is that at least this person should be investing $100,000 minimum with us, right? But with mutual funds, it was like $50 minimum. But now if they want us to separately manage this account for them, well, at least 100,000, I would say, should be the minimum, right? Don't confuse this with a fund of one. Fund of one is a similar concept, but in a fund of one, the customer is still going through the fund. It's just that the fund is set up only for this customer. So you might have a high net worth individual who says, no, I don't want to open an account in my name. I'll just give the money to you. You set up the fund and you manage it, but I'll be like the only client of that fund. So fund of one is different from SMA, because in SMA, the account is opened in the direct owner's name, also called managed account or wrap account, or also called individually managed account. One of the benefits of this is tax, right? Because then you could really look at the individual case of selling and buying securities based on what would optimize the tax for this particular individual. In a fund, you of course can't do that level of customization because you've got so many clients. So yeah, I mean, the benefit is there of customization, but you need a basic minimum amount of investment. Now, of course, our favorite ETFs. Now, how does it work, right? I mean, how does this real-time issuing of units happen? So what you have is an institution that comes in. So you might have a fund sponsor. So let's say I'm making an ETF, I'm S&P, and I'm making an ETF called SPY, which is just going to track the S&P 500, right? Let's say. Now, I'm the fund sponsor. I need somebody to help me do this. So let's say I talk to big institutions like JP Morgan or Morgan Stanley or Goldman Sachs or Citigroup or whatever, right? I'm just giving examples. So these guys will help me dynamically issue ETF units. So I would give them money, right? And they would use that money so first I'll tell them what are the shares they need to buy for me. So I'll tell them, listen, I want an ETF to track S&P 500. So that's the basket of shares. So I'll approach them. I'll tell them what is my ETF plan, right? I mean, what is the ETF going to track? And the institutional investors, they will buy the shares. And what that means is, so that inside, let's say there's Google, Apple, Amazon, all of this, right? So they'll buy all those shares and then create like units of the ETF. How that will be done is that all the Google, Apple, Microsoft shares will be bought. Whatever is inside S&P 500 will be bought and given to the fund sponsor. Now the fund sponsor will take all those shares and they will create units of ETFs. And then those units can be given back to the institutional investors, and then those institutional investors can then sell them to the public. And then let's say if the public wants to sell them back to the institutional investors, let's say these Google, Apple prices go down, so the public wants to sell those shares back, then the institutional investor will buy them back, give them back to the fund sponsor. The fund sponsor will then give them back the shares, and then they can sell those shares. You know, you might be thinking, why is the institutional investor going to be interested in all of this? You know, there's a lot of money to be made through arbitrage. Now, let's say these start going up, right? I mean, Google, Apple start going up. What the institutional investor would then say that if they sold each unit to, let's say, the public at $30, which inside has all of these shares, and they are starting to go up, so then the institutional investor might want to buy it back from the public and then convert it back into their shares and sell them in the market at a higher price. So if there's going to be any difference in what the net asset value of the ETF is in terms of what it has inside versus what it is trading in the market for, right? If that goes high or low than what it's worth, the institutional investor can really step in and make a risk-free arbitrage profit, right? And this really makes their NAV trade close, their market price stay close to the NAV. So in that way, they are like open-ended funds. That open-ended funds also, of course, you're dealing with the fund manager at the end of the day, and you're buying and selling the units very, very close to the net asset value. Closed-ended funds obviously were either trading at a premium or a discount, usually a discount to their NAV. But ETF is like the open-ended fund when it comes to that, because there is an incentive for the institutional investor to make sure that they stay close to the NAV. Otherwise, if it goes higher than its NAV, they will sell. If it goes lower than its NAV, they will buy. And then the beautiful thing about ETFs is, like, similar to closed-ended funds, these can be traded during the day. So if I want to buy a whole market portfolio, I don't want to buy one stock, I want a diversified exposure to S&P 500 when I invest. But then at the same time, I want to buy and sell during the market. So I can just buy a unit of SPY. If it goes down, I can buy more. If it goes up, I can sell it. And I can continuously trade during the market. I don't have to wait to deal with the fund manager at the end of the day, right? I can use borrowed money to buy this or sell this. I can short sell it, again using borrowed capital as well. So it becomes really, really interesting. And there's some other benefits as well with respect to tax, that in very many cases, you don't have to pay capital gain on ETFs, and the fees is also much lower compared to your mutual funds. So ETFs are great. Now, hedge funds, this is of course for sophisticated investors, million plus. Let's take a break. And then we'll come back and talk in a little bit more detail about hedge funds and private equity. Let's do justice to it. So let's take a break, get fresh, come back, and then jump into this material.